this revision video looking at economic growth, the third topic in the macro A-level course. We need to know the determinants of economic growth. Growth in general is an increase in national income, but we tend to divide it into short-run growth and long-run growth. Short-run growth is a change in just aggregate demand or short-run aggregate supply. There's no actual change in the economy's productive capacity. And that's going to be determined by all the things that we've already spoken about that affect aggregate demand and short-run aggregate supply. Economists are usually more interested in long-run growth. The change in long-run aggregate supply, an economy increases its productive capacity, and that will be determined by all those things that we've already met that affect long-run aggregate supply. On a diagram, long-run growth looks like an outward shift in the long-run aggregate supply curve, while short-run growth is just a movement within the PPF of an economy. The production possibility frontier doesn't actually move for short-run growth. Long-run growth would be a movement out in the PPF. If we were going to show it on an economic cycle diagram, short-run growth would just be our fluctuation in the blue line, that purple arrow, while long-run growth would be represented by a change in the underlying trend rate of growth in the economy. We need to zoom in a little bit more onto that economic cycle. The economic cycle shows the fact that economic growth tends to fluctuate around an underlying trend. As we look at economies, what we tend to find is that growth goes up and down, but underneath it is a fairly constant trend rate of growth. There's four key stages to the cycle, the first being the boom stage, fast economic growth beyond the trend. Booms are often followed by a slowdown where the growth rate starts to slow, which lead into a recession, a period of negative growth for 2 quarters or more. Not all economies experience the slowdown phase. Some will go straight from a boom to a recession in the case of certain economic shocks. Recessions, after a while, are followed by a recovery, where the economy returns to productive capacity. That's our basic economic cycle. In the boom period, we have a positive output gap. The economy is often producing beyond its productive capacity. It's an unsustainable way of producing. In a recession, we've got a negative output gap. The economy is below its productive capacity, below its full employment level. We'll have unemployment, we'll have spare resources. We could be producing more. There's a few key causes of this cycle, which lasts about 3 to 10 years, though of course it entirely depends on the country you look at. One major cause is economic shocks, unforeseen events that affect demand or supply. It's often economic shocks that trigger the movement from a boom into a recession. For example, the COVID pandemic in 2020, or the global financial crisis in 2008. They were economic shocks that triggered a recession. But those shocks are much more significant because of things like the accelerator effect and the multiplier effect that we've met previously. These accentuate and exaggerate the impact of shocks. They make the economy more volatile. Similarly, so do asset price bubbles. When the economy is growing, there's often a lot of confidence, leading to people demanding assets just because the price is going up. That's called speculation. But that speculative demand pushes prices up to a point where eventually those bubbles, as they're called, can collapse. And when bubbles collapse, prices fall suddenly, a lot of people end up losing a lot of money, and that can trigger a recession. That's more or less what we saw in the 2008 financial crisis. Fourthly, classical economists pointed to a cycle of credit and debt in the economy. During a boom, lots of positive confidence and good sentiment in the economy meant there's access to very cheap credit, very low interest rates. And that means firms take out a lot of investments which are not very solid. And when those investments start proving not very profitable, that can cause real problems, decrease profits, and end up putting the economy into recession. And again, that's another perspective on what happened in 2008. Not all of these causes always apply, but they give us a rough idea of why we tend to see this cycle. Lastly, we need to know about the impact of growth in the economy. Economic growth is largely a good thing. It improves standards of living. It has had a huge impact in reducing worldwide poverty. Growth is good for governments because as economies grow, governments tend to be able to raise more in tax. Developed countries have a higher tax take as a percentage of GDP than poorer countries. And growth often leads to more future growth. That's because growth often leads to investment. It leads to greater confidence, generating more investment internally, and it also leads to more foreign direct investment from other countries. Of course, growth does have some downsides. Many economists have argued that too much economic growth is a really bad thing for the environment. As countries grow really quickly, the environment is often the thing that suffers. Faster growth rates are usually associated with environmental degradation. Some growth is unsustainable. Short-run growth, or demand-side growth, where we've just got a positive output gap, is certainly unsustainable. But because of the environmental impact, some economists would even say that what we would consider to be long-run growth might be unsustainable as well. Short-run growth is inflationary, because a positive output gap puts upwards pressure on prices, though we couldn't say that about long-run growth. And here's a big one. Growth doesn't have equal impacts. High rates of growth often lead to rising inequality because growth is generated by companies investing effectively. And as those companies invest, there'll be some winners, there'll be some losers. The gains from growth are not equal. So to summarise, what are the impacts of growth? Firstly, on the economy. The economy gains if we have long-run growth. But if we have short-run growth, it causes conflicts and problems. Individuals will gain from greater real incomes on average, but the gains may not all be equal. The environment is likely to be damaged. But on the other hand, as countries develop, there may come a point where they're able to afford environmental protection, things like recycling or developing new technologies that reduce resource usage. And that can improve things for the environment.